I'm extremely worried, yes.
I've been through plunges before, and you just have to stick it out.
No trying to that.
I'm not worried at all.
When you hit 53, you don't want to be worrying about your retirement.
It always goes back up, unless there's a depression, and by that time we won't know.
Please let me know what's going on.
All right, those are your worries and your concerns. Those are the conversations we had with you out on the street this morning. We want to give you some answers. We're bringing in a group of experts, a plunge protection team to help you through this volatility. So personal finance expert Lauren Lyons-Cole is here, wealth manager Tim Speiss, and of course, you know, our own Gerri Willis. So I want to bring you each a challenge. Here is a specific challenge on portfolio balance.
What sort of balance as a 45-year-old man should I have in my portfolio if I have about maybe 15, 20 years left to work?
So, Gerri, 15, 20 years to go. What do you tell this?
So 40, 45. Here's how I want to address this. It depends on where you live and how much money you make, right? But if what you're looking for is $1 million balance, I saw a survey recently of $1 million balance investors who have that much in their 401ks. By their mid-40s, they had $450,000 sitting aside. So that's what people who are smart, that's what they do. These are not people with a ton of dough. They're not earning huge amounts of money.
What were they doing?
Setting aside money regularly, putting in the limit, making sure they're getting the employer match, and they are in stocks. One other thing I want to say quickly. Hey, take a breath. The Dow for the week is up 1.1%. The S&P 500 is up marginally, and the Nasdaq is up 2.6%. It's not that bad. Had you sat and done nothing, you would be in great shape.
So maybe, as you said earlier, Gerri, maybe if you got locked out from your personal trading account, it was actually a better week than other. Here's someone that we reached out to who talked about how difficult it is to get returns in this low rate environment.
Where can you put your money that's somewhat safe, but you're still going to make some returns on it without being too risky? Besides a money market account, which really doesn't yield you anything.
So, Tim, to me, that's the golden question. She asked the right question. You cannot get paid for any investment. Right. Somebody like that should not be in high yield debt. So what do people do?
Well, first off, she wants to be diversified. So I think any of us, the first thing we do is understand her risk tolerance, goals, and objectives. People need to be educated. So she'll ask that question. There are high yield bonds. There's corporates that pay very high rates. There's also some very strong municipal governmental debts that's available in the marketplace. But I would not be overweighting on just high yield bonds.
So let me ask
There's no
you
one
this.
answer then, right?
There's this whole new crop of products out there, which are mutual funds. You can put in as little as $1,200 that mimic hedge fund strategies. Long, short, one of the most common ones. What do you make of those, these 40 Acts?
But even then, you got to remember that the whole thing about the hedge funds is minimizing risk, right? So I'm loath to give a silver bullet answer. I think we're all much better at responding, but giving options and choices, because I hope our panel would agree there's really not one single solution.
No, right. Certainly not.
But so what she should do is sit down with an appropriate, knowledgeable party and understand first what her options are, and then get independent guidance on what to invest in.
All right. Now there are people who are very close to retirement who are really afraid of losing their nest egg.
I am, close to retirement, so I would like to know what my investments can bring me for the future, say in the next 5 to 10 years.
So, Lauren, for someone like that, that's not somebody who should be adding risk, right?
Right. I mean, 5 to 10 years away, I think what you really want to do at that point, of course, no crystal ball. I can't say what the investment returns will be, but what I can say is how much money you need to live the life that you want to live in retirement, so we can assess where you're at today and figure out.
Plan backwards, produce backwards.
Exactly. And that might mean investing a little bit more aggressively if you need to catch up on lost time. It could also mean working for a couple extra years or, saving more now.
All right.
Yeah, we didn't talk a lot, but the panel here, very adept. There's actually allocation models that investors can mimic and get advice around. For instance, what percentage in fixed income, large cap, small cap, even emerging markets, which have been beaten up over the past 10 years, they barely generated 1%. But remaining diversified and being in as many of these asset classes as you can, know what your income needs is going to be, know what a target accumulation balance is going to be, and you're still going to have to take some risk if you're trying to hit a target balance.
All right, hold those thoughts. Excellent point, all of you. We have a quick break to take.